to welcome you to this month's Baird Wealth Strategies webinar. Our topic today will focus on protecting what matters most with insured solutions. I'm joined today by Blake Panosh, Manager of Insured Solutions, and Erica Kroll, Insured Solutions Consultant. Today we're going to discuss the need to safeguard against potential threats to your portfolio in your wealth management plan. For those of you unfamiliar with Blake joined Baird in 2006 and manages the day-to-day marketing efforts of insurance and annuity solutions to Baird financial advisors and their clients. Additionally, he oversees strategic planning for Baird's Insured Solutions Department. His team employs a needs-based approach as they help clients understand the potential solutions available to them, whether those solutions involve the use of insurance or not. They take great pride in delivering the best possible outcomes for clients based on their current and future needs, goals, and objectives. For those of you unfamiliar with Erica joined Baird in 2003, where she's responsible for supporting Baird financial advisors and their clients with insurance-based planning needs. By working through the Baird wealth management process in a consultative manner, Erica is able to incorporate insurance into the overall financial plan to enhance the client's goals and objectives. Before I turn the call over to them, I do have a few housekeeping items that I'd like to highlight. For optimal viewing, we would suggest setting your layout to the side-by-side view via the circle in the upper right-hand corner of your screen. All participants are in a listen-only mode, but we would love to hear from you, so we will host a Q&A session at the end of today's webinar and address as many questions as time permits. You can submit a question by clicking on the Q&A icon on the bottom right-hand side of your screen. Just please be sure that you're addressing your questions to all panelists. This presentation is being recorded and will be made available along with the slide deck through your Baird contact or via bairdwealth.com about a week following today's presentation. With that, thank you everyone for joining us. Blake and Erica, thank you both for being here. I'll now turn it over to you.
Thank you, Justine. Appreciate the introduction, and certainly thank you to everyone joining us today for this discussion. We really, Erica and I truly appreciate the opportunity to be here to discuss this topic. It is an emphasis, as was alluded to, specifically on life and long-term care planning, more specifically. So we're really excited to be here with you. So a little bit about what we're going to cover here today. We'll start today's discussion just with an overview, a brief overview of our Baird Insured Solutions team, a little bit more about who we are, how we help our financial advisors, and ultimately you all as clients know about the resources and subject matter expertise that's available to you when you're working with your Baird financial advisor. After that, we'll jump into some of the more common utilizations for life insurance. Given our team spends a large portion of our day or day-to-day reviewing clients' insurance portfolios, we often encounter clients who can't recall why they originally purchased a policy, much less have a better understanding of what it is they currently own or possess in their insurance portfolio. So this will be a good refresher course for that, certainly, but may also spark an additional need or two that you may have personally. And then, as mentioned, we're thoroughly engaged in the process of reviewing existing insurance portfolios. So we'll talk a little bit more in a little bit more depth about why that's important, why a regular review of your portfolio makes a lot of sense, and when or what are some of those situations that could prompt the need for an additional review. And then lastly, the last half of the presentation, Erica is going to close the discussion with an emphasis on the importance of planning for a long-term care event. I think you'll see and you'll learn that the reality when it comes to long-term care is that everybody has a plan. You just might not realize it, and it may not be the most ideal plan ultimately for you and for your family. So Baird Insured Solutions, our team is really here to assist our financial advisors and our clients with anything and everything related to the world of insured solutions. And we're very, very quick to use the word insured solutions because that's how we think about ourselves as solutions providers. Not product pushers, and we're here to provide our clients and advisors with that independent, objective, consultative advice on insurance-based solutions. So know that we're not here to sell you anything. We're here to advise and consult and help you understand what it is you have and or how an insured solution may or may not play a fit in your overall wealth management plan. In addition, we partner with some of the top intermediaries and carriers in the industry, so we feel very strongly about our ability to provide broad access to the market so that we're ensuring that you're receiving an outcome specifically tailored to meet your unique needs. And on the topic of needs, as we jump into the life insurance planning portion, we feel it's a good idea and important for our clients to have a better understanding of some of the most common utilizations for life insurance. And without adding, I'll just add this as sort of an aside here, without adding that layer of protection to your current financial situation, all the goals, suggestions, strategies, recommendations that's made by your Baird financial advisor, or really any advisor, could be completely undone by a simple twist of fate. And that simple twist of fate has the potential to have a downside impact, in particular on those you've left behind, in a number of different ways, again, many of which are not overwhelmingly positive. So as we jump into this, I think it's important to note too that many insurance practitioners will really tell you that there's generally two categories of life insurance needs. There's estate creation or estate enhancement and estate liquidity. And while that is certainly true, we really prefer to segment these into what we call 4 primary planning buckets. And that's what you see here on your screen. So personal protection planning, estate and wealth transfer planning, business succession and or continuity planning, and lastly, retirement or income planning. So we'll take a deeper dive into each one of these, starting here with the personal protection planning side of things. This is the area or the planning bucket, if you will, that's likely to resonate with a lot of people. This is the need to really safeguard against a premature death. For those of us that have dependents who rely on our ability to earn an income and ultimately provide for them. Sometimes this gets categorized or lumped in as very simply basic income replacement and debt repayment. But there's a lot of additional reasons for personal protection planning, some that are very commonly overlooked. The most important of that being dependent services, also known as the stay-at-home parent, if you will. The services and contributions to the betterment of the family should not and cannot go unnoticed. And unfortunately, in situations like this, usually that's highlighted or emphasized after something tragic has happened. So we want to try and safeguard and be preventative on that front. In addition to that, providing for the care of a loved one who may have special needs, funding your children's or grandchildren's educational needs. The other topic too that's important is final expenses. This is very commonly overlooked as well. Final expenses have gotten increasingly more expensive over time, not surprisingly. Without getting overly morbid, average funeral costs these days are now closing in on $10,000. And again, that's the average. And with the movement towards high deductible healthcare plans and out-of-pocket expenses associated with Medicare programs, it's really not uncommon to think that there could be another $5,000 to $10,000 in additional final medical expenses. Obviously, these are all things that we hope no one has to worry about. But the reality is it can and does happen. And having life insurance in place to safeguard against these items can provide the needed peace of mind for you and for your family. Some considerations to think about, questions to ask yourself in determining whether you have a need for personal insurance protection. Again, are you responsible financially for the well-being of others? Do you have people that are relying on your ability to provide services, care services, getting them to and from activities or athletics, things of that nature, putting food on the table, doing the groceries, all of these various homemaker services that get overlooked? And then lastly, do you have enough to pay for final expenses? The key there, don't forget to think about and consider your max out-of-pocket healthcare costs in that analogy. The next bucket is the estate and wealth transfer planning bucket. And this is where we might utilize life insurance to provide that estate liquidity that I talked about earlier. Ultimately, for most, this is typically used to pay federal estate taxes, probate expenses, and other administrative items. But with the changes in federal estate tax law over the years, this has really altered this particular need for many people. With that said, don't forget, many states still impose state estate taxes. And this is an area that your financial advisor can really help you uncover and work with our estate planning team to assess your risk for this. An overlooked area for life insurance in estate planning is using it as an estate equalization tool. The most common situation and theme that we see on our team is really the business owner who may have children that are interested in continuing in the family trade, and at the same time may have other children that have absolutely no interest whatsoever. So in most cases, the business being one of, if not the most important and most valuable asset that a business owner owns, if you're going to pass that business to some of your children, the question you have to ask yourself is, do you have an interest in equalizing the value of that asset in some way, shape, or form to your other children who might not be involved in the business on a go-forward basis? And that's really where life insurance can provide an affordable means for equalizing that benefit to all of your heirs. Because the most important quality of life insurance is that the death benefit proceeds pass income tax-free, and again, too, when properly structured, they can pass estate tax-free as well. It really provides a unique means for transferring wealth in a highly tax-efficient manner. So oftentimes, what we'll do on our team is take a look at tax-inefficient assets, IRAs being one element of it, or other qualified assets that may not pass in the most efficient way to heirs, and basically maximize the amount we can pass to heirs by using life insurance. Again, because that income and estate tax-free component makes it significantly more improved leveraging of that asset to beneficiaries. And lastly, for those that are charitably inclined, utilizing life insurance can be a great way to both leave a legacy and or replace the value of any assets that you may have gifted to charity. Another area that our estate planning team can also help with. So considerations here, do you have a future estate tax liability, whether that's federal or state? How liquid is your current estate? We oftentimes see clients that have the majority of their assets that may be tied up in illiquid investments or assets, like real estate, or again, like a business interest. Using life insurance can really provide that increased liquidity to safeguard against the risk of what we would call a quote unquote fire sale, where you're having to liquidate those assets in an ill-timed market. Do you have any equalization issues? Again, with the business interest being most common in this case. Do you own any assets that maybe have been earmarked as a leave-on asset? So for those of us that are near or in retirement, you may have taken some time to designate certain assets as live-on versus those that are leave-on. And it's those leave-on assets where you can really gain additional leverage by utilizing a life insurance strategy to maximize the amount of wealth that you're able to transfer. And lastly, again, the charitable inclinations, an area that our financial and estate planning team can work with you and your financial advisor to help in that regard. The third bucket involves business planning needs for life insurance. Most business entities have worked with an attorney to draft and hopefully execute a buy-sell agreement for the orderly transfer of business interests, whether that's at retirement, that's at death, it may be due to disability. The reality, though, in what we see is that very few buy-sell agreements are actually funded or adequately funded. So oftentimes we'll use a life insurance strategy to really safeguard against the disruption in the transfer of the business interest in the event of a premature death. Disability income insurance can also be used in that situation in the event of a disability. In addition to that, life insurance can provide the business some much needed liquidity in the event of a death of a key employee, somebody who is critical to the ongoing production and growth of the business itself. So this could be somebody like a top salesperson or anyone really who is intimately involved in the operations of the business, whereby if something were to happen to that individual, the business would basically experience a significant hiccup in production or income or what have you, and the ability to at least provide some financial liquidity in a situation like that to at least be able to minimize the hit from an operational perspective and or to hire and educate and train a new employee for replacement purposes. That's where the life insurance proceeds can be very beneficial. And then beyond that, there's some additional business applications that might be used for executive benefits planning. That could be for retention purposes, for key employees or for all employees. So again, considerations here. What are the intent for the business? What is the intent for the business if one or more of the owners were to die prematurely? And to that end, is there a buy-sell in place? If so, is it adequately funded, or is it even being funded at all? Do you have any employees, again, going back to that key employee situation, who are critical to the growth and the success of the business on an ongoing basis? And then lastly, what strategies are currently being utilized for employee retention? The last bucket here is life insurance strategies that can aid in retirement, leading up to retirement, or for income planning purposes. Many times we'll use cash value life insurance policies in these situations because the internal cash value growth grows on a tax-deferred basis. In addition to that, in subsequent future years, you can access those cash values on a tax-advantaged basis. And I'm not going to cover in detail what that means, but just know tax-deferred growth, when properly structured, can take distributions on a tax-advantaged basis. The flip side to that, for those that are in retirement, again, goes back to thinking about that live-on versus leave-on asset. So thinking about how can I start to think about ways to maximize the amount of wealth that I can transfer to my heirs. Again, that's the topic that we covered during the estate planning utilization slide. And then lastly, protecting your assets from a disability or a long-term care event become increasingly more top of mind as we age. There's opportunities now. I'll talk a little bit more about this. I'm not going to steal too much of Erica's thunder because she's going to cover this in more detail. But an opportunity now to leverage existing life insurance into something that will provide both death benefit coverage as well as long-term care protection in the event that it's needed. So considerations within this bucket: are you currently contributing the maximum amount you can to retirement plans, 401ks, IRAs? And if so, after that, do you still have an interest in investing and obtaining additional tax-deferred growth? That's where, again, using a cash value life insurance policy can provide that much needed death benefit in the early years when it's most needed, as well as that cash value, that tax-deferred cash value and buildup that you can access in your later years and use it as a living benefit. And then lastly, what assets would you liquidate if a long-term care event were to occur? So we've covered the various reasons why you might have purchased a life insurance policy or policies in the past, or what needs you might have that you should think about or consider adding a life insurance policy. But now we need to talk about why it's important to review your policies on a regular basis. So policy review is really nothing more than a complimentary assessment of your insurance portfolio and your current, more importantly, future needs, goals, objectives for insurance protection. It's meant to be 100% complementary to your overall financial plan that you work with your financial advisor with, because it's there to protect the assets that you're trying to build within that financial plan. The process also, importantly, allows you to understand what it is you currently have, and also to ensure that the type of policy that's being utilized is really properly aligned to meet your unique needs while making sure you're getting the best possible pricing possible. So going through this process really should be intriguing, because it's an opportunity, again, for you to get a more thorough understanding of what you have and or how an insured solution may or may not play a fit in your overall financial strategy. So aligning your portfolio, your insurance portfolio, to your specific needs and those of your family is really critically important to ensure that you're getting the maximum you can from your insurance policies. Beyond that, though, one of the very baseline things that we're going to do, review things like ownership structure, beneficiary designations. Eric and I could probably carry on for days for the number of times that we've seen a mistitled insurance policy, which can have significant adverse tax impacts on you and on your beneficiaries if they're not properly structured. Beneficiary designations, we still see those that are not aligned with what the policy owner desires. So again, something that needs to be reviewed on a regular basis. And then in many instances, we're also able to find money for clients or free up cash flows just by making minor tweaks to their existing insurance policies. This just increases financial flexibility, frankly, and aids you in accomplishing more of your goals than maybe you ever thought possible. So the reason we started out with the common uses for life insurance prior to this point is, again, we really see the overwhelming majority of clients that are entering a different phase of their life. Oftentimes it's being near, at, or in retirement and beginning to question, why do I need this insurance? Why do I still have it? Why am I still paying for this? So regardless of the initial application for it, the questions are starting to roll. And that's typically when we're having these conversations with clients. But in addition to that, talking about some of the other personal and industry related changes that maybe might prompt the need to review the portfolio. A lot of the personal changes involve a change in family status, whether that's a new addition to the family with a child, grandchild, marriage, divorce. But in addition to those items, changes in employment, changes to your benefits at your workplace, any changes for you personally in your health, your well-being, your lifestyle. These can all impact the future state of your insurance portfolio. Changes to your overall net worth through assets, liabilities. If you are a business owner or have an interest in a business, any change to that ownership structure can certainly impact or prompt the need to take another look at your insurance portfolio. In addition to that, though, the industry is changing, and the industry has been changing significantly over the years. Many policies have underperformed as a result of low interest rates or dividend rate fluctuations. In fact, a lot of policies that were issued in the 80s and 90s, fixed rate policies, were originally illustrated and ultimately sold with an assumption of an 8 to 10 or even a 12% fixed rate of return, which obviously has just not been sustainable for insurance companies, in particular the last 20 years. So as a result of that, what we see is a lot of these policies have already lapsed or are in serious danger of lapsing prematurely. So what a lot of folks thought was intended to be a permanent policy is really turning out to be anything but. In addition to that, changes to the financial rating of insurance companies, we've certainly seen a lot of movement in that regard over the course of the last 10 to 12 years in particular. We've seen improvements of underwriting over time, although COVID did throw a little bit of a wrench in that over the last few years here. But ultimately, for the most part, it's been for the better. Tax law changes, all of these things have factored into this and really create the need, and it may be things that aren't on your radar, create the need from an industry perspective to, again, take a look under the hood, take a look at your policies. Are they still performing optimally? Are they still doing the things that you intended for them to do? And are they still meeting your current and, more importantly, future state needs, goals, and objectives? And then lastly, I'll just say from an innovation standpoint, insurers have added new products, and I think perhaps most importantly, new riders to their offerings that make them significantly more attractive to consumers. The advent of the long-term care rider to life insurance policies, sometimes it's integrated in there, sometimes it's an added feature. It's really diminished the use of a traditional standalone long-term care policy. So as a result, when we're reviewing existing insurance portfolios, oftentimes we're pivoting to a more appropriate policy that's covering greater needs, which includes the need for long-term care. So with that, I don't want to overstep my bounds and ultimately start to impinge on Erica's territory. So at this point, I'd like to turn it over to my colleague, Erica Kroll, and she's going to cover the insurance planning more from a long-term care perspective. So Erica, it's all yours.
Thanks, Blake. As you mentioned, I'll spend the rest of our time together here talking about long-term care planning, as well as the critical role it can play in protecting your family finances and peace of mind. I want to start out by making sure we define our terms, because it's important to understand that long-term care is very different from traditional healthcare or Medicare. Healthcare and Medicare are designed as curative or rehabilitative programs. in that they cover hospitalization, doctor's fees, lab services, and drugs. Long-term care is very different in design, though, as it covers custodial care or non-medical care. It's the assistance provided to someone who can no longer live independently. And that could be a result of a chronic illness like diabetes. Perhaps it's a disability like a stroke, or a cognitive impairment like Alzheimer's disease, or simply just growing old and frail and needing some assistance. Long-term care can provide assistance with activities of daily living like bathing, dressing, transferring, as well as supervision due to a cognitive impairment. It can cover care received in your own home or a range of venues such as adult daycare centers, assisted living facilities, memory care facilities, nursing home, or hospice. If you're receiving care at home, it can also include instrumental activities of daily living, such as grocery shopping, meal preparation, housekeeping, laundry, things like that. Most people still think of long-term care insurance, or excuse me, as long-term care as nursing home care. But today, however, the majority of care is received at home, with over 50% of claims starting at home. And the majority of those claimants never change venues. So what's the risk of needing long-term care? The government projects that by the time we reach age 65, 70% of us will experience a long-term care event. 7 in 10 Americans will need care. Most of us think of long-term care as an end-of-life situation when we're elderly, but in fact, today, 40% of those receiving care in the US are under the age of 65, with the primary reason being motor vehicle accidents. The point is that a long-term care event can happen at any time. This slide shows the cost of care in 2021 for non-medical care, assisted living, as well as nursing home care, and then the projected cost 20 years from now in 2043 using a 3% annual increase. I just want to point out the reason we're using 2021 numbers is simply because that's the latest data that we have as it relates to this survey. We're expecting the 2022 numbers to be available sometime in April. But if we look at the first section for in-home care or non-medical home care, it's just over $59,000 annually today. 20 years from now, in 2043, the cost of care for 44 hours of non-medical home care is projected to be over $113,000 annually. The median cost today of a private room in a nursing home is $297 a day, or about $108,000 a year. And 20 years from now, that cost is projected to be $569 a day, or over $207,000 annually. Traditionally, in our country, people have received long-term care at home provided by family members. However, there's fewer family members available to help out as a result of divorce, more women in the workforce, smaller families being scattered across the country. So relying on family members to provide that care is not the option that it once was. And research indicates that the estimated total loss of wages, pension, and Social Security benefits of family caregivers is nearly $3 trillion. So depending on adult children to provide that care can have a pretty significant impact on their future financial security as well. Predicting how long somebody will need care is very difficult to answer because there's a lot of factors that go into it. But we do know that based on claims history, 40% of claims will last less than 1 year. Those claims include short recoverable illnesses like knee replacement, maybe a sudden terminal illness diagnosis, or use of non-care benefits like having a wheelchair ramp installed into your home. About 60% of claims will last more than a year, and of those, the average duration is 4.3 years. 20% of claims last longer than 5 years, and those claims tend to be associated with dementia or cognitive issues. So, how will you fund a long-term care event? For most Americans, there's really 3 ways to pay for long-term care. The first would be to self-fund or pay for care out of your income, savings, liquidating assets, and about 17% of the cost of long-term care today is self-funded. Another way would be to transfer the risk to an insurance company. Currently, only 6% of the cost of long-term care is paid for by private insurance. And that's because so few have planned for a long-term care expense. The third way to fund for long-term care is to qualify for Medicaid. Medicaid is funded by state and federal tax revenues. About 43% of the cost of long-term care in the country today is paid for by Medicaid. However, in order to qualify financially, there are requirements that will impact your income as well as your assets. Between Medicaid, Medicare, and other public funding agencies, the government pays about 72% of the cost of long-term care. As we all know, though, these programs are already stretched, and many people mistakenly think that Medicare will cover long-term care, and it will pay for some custodial care, but it should not be considered an alternative for long-term care insurance. Medicare will cover 100% of the first 20 days in a skilled nursing facility, providing that specific requirements are met. After the first 20 days, Medicare will cover a portion of the expense for the next 80 days, but the Medicare beneficiary must be able to pay the daily copay. And then after you get to 100 days, Medicare pays very little in the way of long-term care expenses. Claims history indicates that the average number of days paid by Medicare is about 25 days. And keep in mind that Medicare does not pay for care provided in assisted living communities, custodial care for chronic diseases like Alzheimer's. And that's because Medicare is designed to be curative or rehabilitative in design, not custodial. Having a plan in place for a potential long-term care event is very important. And with 3 questions, we can begin this planning process. The first is, if you needed care, where would you want to receive care? Most of us want to remain in our homes, but is that realistic? And other care venues may include living with a family member, perhaps a group or residential home, continuing care, retirement communities, assisted living communities, or nursing home care. And second, if you were to need care, who would you want to provide that care? We often hear that people want their spouse, partner, kids to provide that care for them, but will that partner still be living if care is needed? Would he or she be healthy enough to provide that care? Would they really want to be your hands-on caregiver? So those types of things need to be considered, and having that discussion with family members is important. The third is, if you were to need care, how would you pay for formal care? And if you could afford to self-fund, it's still important to have a plan in place to determine what assets would be liquidated first to pay for care. We would also want to take into account the taxation of those assets. As Blake mentioned, we all have a plan in place. We just may not know what that plan is. So I think talking to your Baird financial advisor and making sure they understand what assets, the taxation on those assets is very important. The looming cost of long-term care for aging baby boomers is going to be huge for all of us, our families, our states, and our country. And in fact, there are multiple states considering taxing those who do not currently have a long-term care contract in place. This tax is intended to help fund the Medicaid program. And in 2021, the state of Washington implemented a payroll tax of 58 cents on every $100 that you earned. For those who pay into that tax, then the state will provide a small long-term care benefit of $36,500 of lifetime benefits, which, as we just saw in a couple slides ago, that may cover about 3 months of care in today's dollars. So not much of a long-term care benefit. Also, Washington residents were not given much notice, but they were given a short period of time in which they could purchase a qualified long-term care contract and then be exempt from the tax. However, that did put a strain on long-term care insurance companies who were attempting to underwrite these types of policies. We're now seeing 12 states considering something similar to what Washington did, and it appears that California and New York are going to be next in line. There's also numerous proposals at the federal level to help alleviate the strain on Medicaid as well, but there's also a lot of uncertainty as to what will actually happen. The latest was the Secure Act 2.0, which includes a provision that allows taxpayers to withdraw up to $2,500 per year. That amount will be adjusted for inflation in later years from a traditional retirement plan to cover the cost of a long-term care insurance policy without triggering the 10% early withdrawal penalty. The withdrawals are still going to be subject to ordinary income tax. You just avoid that 10% early withdrawal penalty. That new provision is effective for tax years beginning after December 31st of 2024. So we get asked a lot about who should consider long-term care insurance, and that decision is very personal and situational, but there are things that we will take into consideration. First would be your assets. And if you have assets that you want to protect, long-term care insurance can be a prudent strategy. The market for long-term care can vary depending on who you ask. The Wall Street Journal has defined the market as those with assets under management of $500,000 to $5 million, excluding your real estate. Insurance companies, however, generally define that market as those with assets of $50,000 or greater. Financial goals will come into play here as well. We'll ask questions like, do you plan to transfer wealth? Do you want to spend your savings or liquidate assets if you need care? The target age group for insurance is between 50 and 80, but most people do buy insurance between the ages of 55 and 65 for two reasons: health and affordability. If you're part of a couple, the concern we often hear is, how will my spouse or partner's standard of living be impacted should I need care? And for singles, primarily women, we do tend to outlive men by about 5 years. So needing to pay for a formal caregiver is highly likely. The amount of people without a spouse or partner or children is also growing. So if care is needed, it's likely that a lot of people are going to need to rely on paid caregivers. So I understand there's a lot on this slide and it's probably small for viewing, but the main point to remember is that there are two different types of long-term care insurance products in the market today. And Blake touched on these a little bit during his discussion, but the traditional standalone products, which are presented to the left of the line there, and then asset-based products, which are shown on the right. Think of traditional long-term care products like you do your auto insurance or your homeowner's insurance, in that you'll figure out the amount of coverage that you need or want, what your deductible should be, then you pay your premiums and hope that you'll never have to file a claim. The premiums are sunk cost, or in other words, you don't expect to get any money back from the premiums that you've paid. But at the same time, premiums on a long-term care product work the same. These types of products are the most customizable and the least costly solution if long-term care is needed. The downside is that the premiums can increase, and if care is never needed, there's no residual value or return of premium to you or your beneficiaries. So you may have heard a lot about asset-based or hybrid products, which again are the three listed on the toward the right of the line there. These are usually designed on a permanent life insurance chassis or an annuity chassis that include long-term care riders. There's a number of variations of these products and product designs, but the majority are designed to leverage the premium 2 to 3 times to create a pool of funds to be used for care. With the life insurance-based product, if you pass away never having a long-term care event, then your beneficiaries will get your money back in the form of a tax-free death benefit. If you need care, that death benefit can be accelerated to help pay for long-term care while living. Premiums on these types of products are guaranteed to never increase too, which is valuable to a lot of clients. Annuity products are similar in design, but are based on cash value rather than death benefit. And those are usually easier to qualify for medically than the life insurance type products. Planning for a long-term care event or expenses can be complex, but through the years, we've attempted to streamline this process for you to simplify it through a 3-step approach. The first is that we will ask detailed health questions and get a detailed health history. And that's simply because health history will drive the decisions about the carrier, the product, as well as the cost of insurance. The second step would be an educational meeting. Most of our clients are not well informed about long-term care or what long-term care insurance can cover. And we want to make sure that you understand the issues surrounding long-term care so that you can make a better, more informed decision. At this meeting, your financial advisor will also review the recommendation for coverage based on the amount of potential expenses that you want to offset, or perhaps the premium budget that you've defined. The third step is the application, and with the help of our external partners, we'll walk you through this process. But really, we just want to make sure that the applications are complete and easy for underwriters to read and understand to hopefully make that underwriting process smooth for you. And with that, I will turn it back over to Justine.
Great. Thank you so much, Erica and Blake. We really do value all of your expertise in this space. We will take some time to answer some questions, and I don't see any in the queue yet, so I'll remind our audience, if you'd like to ask a question, you can do so via the Q&A button on the bottom right-hand side of your screen. Just please be sure that when you ask a question, you submit it to all panelists. And I do see a couple coming in here, so Erica and Blake, I will turn it back over to you.
Thank you. Yeah, I see one about the long-term care coverage. I think this question came in prior to the slide I talked about the target market, but just to readdress that, the question was if I can get coverage if I'm 63 years old, or what about 69 years old? And again, most insurance products that we have available will issue up to age 80. However, it can be cost prohibitive, I would say, once you get above age 70. So it's usually that target market for long-term care planning is between ages 55 to 65. Another question here is the next step to for an insurance review as well as needing long-term care insurance. And for that, as Blake mentioned, we partner with your Baird financial advisor. So I would say the next step would be to get in contact with your advisor. They can loop Blake or myself or another team member in, and we can help you get started with that review and discussions around long-term care planning. Another question, I'm assuming this will be for long-term care, but it's how much are monthly premiums? That is going to vary greatly depending on the type of product, your health status, obviously age, gender can come into play, how we design the policy. So, really, I would say work with your Baird financial advisor and we can look at some customized quotes for you.
So question around COVID's impact on life insurance premiums and or underwriting. I would say that it changed during the interval of COVID as a pandemic. Since coming out of that pandemic experience, we've really seen a return to norm. So pre-COVID pricing, pre-COVID underwriting, if anything, underwriting actually has improved and is much more streamlined, in particular on life insurance as a result of COVID. COVID pushed archaic insurance companies into a more digital world and digital experience, something that, not that they had been resisting, but just hadn't quite figured out all of the best practices around being able to underwrite in a more streamlined environment and in a more digital era. So if anything, it has made it significantly easier from an underwriting perspective. Make no mistake, in particular for life insurance, there's still a lot of poking and prodding during that process, but by and large, there's even opportunities to bypass some of that too. Great question.
I'm not seeing, oh, another one just popped in.
I see a specific question here regarding health history and worth looking into long-term care. Again, I would say let's connect with your Baird financial advisor and we can talk through specifics of that. Some carriers have loosened up underwriting as it relates to health history of cancer and things like that, but we would want to make sure that, again, through that detailed health history, health questionnaire, that we could get the insurance for you.
Awesome. We'll give it maybe just another 30 seconds here to see if any other questions pop in. Right. Well, Erica and Blake, thank you both so much. Your expertise is unmatched, so we really do appreciate it. As Erica and both Blake mentioned, if you have additional questions or specific scenarios that you want to talk through, reach out to your Baird financial advisor and they'll be able to loop Erica and Blake back into the conversation to find out what needs are best suited for your situation. So for those of you, again, who would like to review today's presentation, the slide deck or the recording, both of those pieces will be made available in about a week. And you can get those through your Baird financial advisor or via bairdwealth.com. And again, if we're unable to address any of those questions, loop in your Baird financial advisor and we will be sure to connect you with the appropriate resources. So thank you everyone on the line for your time today. And Blake and Erica, thank you both so much again for being here.